Hey, all you busy healthcare professionals out there, it's Amir Baluch, your host of Wealth Strategy Summit, back again on our day concerning alternative investments. And this is actually one of my favorite topics. We're going to talk about private equity. This is just a little bit of a primer, and you're going to get a lot of insight from our guest today. His name is David Sawyer. He is the CEO and managing member of Legacy Knight, which is a multifamily office, and he's going to explain what that is. And he's actually based in Texas, and he's doing a lot of private equity at a very high level. So we're very happy to have an expert like him explain this private equity world to us. So David, thanks for being on board today.
Absolutely, Amir. Thanks very much for having me.
Yeah. So, your path to get into private equity is probably different than other people's. How did you fall into this, and kind of what was your background? How did you end up becoming like a managing member of a multifamily office? What is that? And, how do even people train for this and get involved in this?
Sure. Well, I have a little bit of an alternative background in the space. So I'll tell you what I did, and I'll also tell you how most people do it. It's a little bit different. There's no right way, but I started through law, went to the University of Texas, and then went to the University of Houston for law. Before law school, I worked in corporate transactional law at a firm here called Vincent Elkins. Really enjoyed working on the legal side of IPOs and M&A work and things like that. And so when I went to law school, I thought I wanted to go be a corporate transactional lawyer, but then I got interested in the sort of policy and regulatory world. So I actually spent several years after law school doing kind of politics, policy, and regulatory work. And then about 6-7 years ago, I decided I wanted to go back into finance, and I joined a firm here in Houston that does private equity investments. And so I spent 5 years there, became a partner, and then joined Legacy Knight in 2020. And we launched our firm in 2019. So we're fairly new to the game as a business, but we've all been doing this for a long time. And so I took a little bit of a different route. I'd say that most people, the way they get into private equity, there's a very clear path. They do their undergraduate, and then they typically go to an investment bank and spend several years in investment banking. Most people don't go from college to private equity. They typically go into a big bank. They spend several years working, 100+ hour weeks, and grinding and pulling all-nighters and all those things. And then they either go back to business school or they get recruited by a private equity firm. And then they take that path. Some people, they go to business school, then they go into private equity. So that's the path you typically see. Again, mine's a little bit different, but there's no right way. I think my alternative background actually gives me a unique way of looking at things, I'd say, in my space.
Those 100-hour weeks almost sound like residency for us. So
that's right. Yeah. I've done my fair share. Yeah.
So you mentioned a couple of words, or we mentioned a couple of words. We mentioned private equity and we've mentioned multifamily office. Can you explain what those two things are? Because some people might not be familiar with those terms.
Yeah, absolutely. I'd say that, the main investors in private equity, traditionally the investors in private equity were your big endowments, pension funds, insurance companies, very high minimums, very hard to access. In the last decade or so, there's been a real proliferation of family offices wanting to invest in private equity, and more so the private equity firms and managers realizing this was a great source of capital. And I'd say it's family offices and high net worth individuals. A group like mine is sort of an intersection between those, because what we do is a multifamily office. If you're a family that has a net worth somewhere between, say, 10 million and 250 or 500 million, which seems like a wide range, but it's really not. I mean, you really can't run your own family office with an outside staff and things like that. You just don't have the scale, and also the diligence capabilities and things like that to do it. But at the same time, you're sophisticated, you're qualified. So what my group does is essentially aggregate high net worth individuals, ultra high net worth individuals, family offices. And so we do private equity deals, and I'm encompassing venture, private capital, et cetera. We can talk about that in a little bit, all into one. And so we're able to invest alongside you with our family's capital into those. And we also help families run their own family offices within our structure. And so we're a shared resource on the investment side, operations side, legal, tax, et cetera.
Got it. And so you mentioned a couple of things under the umbrella of private equity. I think most physicians are invested pretty heavily in public equity. sometimes whether they want to or not, because most of their retirement funds are probably in public equity and public stocks. So how does private equity differ from that? And what are some examples or subcategories of private equity?
Sure. I mean, I'd say the basic definition is that the investments, instead of being public and liquid, are private and typically illiquid, meaning that you can't go sell them tomorrow if you want to. And that can be a blessing and a curse when you're making a private equity investment. I'd say that I'll call it private capital, because private credit has become a big space in the last 10 years. So private capital is just essentially, very similar investments you'd make in the public markets, except you're investing in private companies or private, maybe a private loan and private credit, for example, not a bond that's publicly traded. Or it could be a privately traded credit instrument. And so that's the space. And I mean, I'd say that the distinctions are, again, I mean, they're illiquid. And some things they're, maybe you can have liquidity in a month or a week, and sometimes it may be, years and years. It could be just you own this until you don't, if it's a company that needs to sell. So it's definitely a different liquidity profile, and that's something to be cognizant of. But that also means you don't have the public market roller coaster every day that you tend to have, especially in the last year or so. We've definitely seen that. So there are pros and cons to the structure.
Got it. So what do you feel is most attractive about this asset class?
Yeah, absolutely. I mean, look, I think that private equity, if you look at the last 25 years, it's outperformed the public markets. That's just reality. And not only has it outperformed the public markets, but the volatility has been significantly less. And so, even if the public markets have given you a, 10-ish% annualized return, 12% or so, private equity has gotten you about that. But if you look, private equity kind of does this, and the public markets do this. And particularly if you're a physician and you're spending your day in the operating room or seeing patients, the last thing you're going to be worrying about is what your brokerage account's doing, going up and down and up and down. And do you need to be watching it? Should you be selling it? So there's a real peace of mind investing in private companies that they look at a lot of that as just noise.
Got it. Yeah, and one important thing you mentioned with that volatility, I write in my book a lot about the compound annual growth rate.
Great.
So David, I'm glad you mentioned that, because when you're talking about that lack of volatility, I talk about compounded annual growth rate in my book. And basically, like, let's say the stock market is doing 8%, but every once in a while, you get a dip. If you actually look at what you're compounding and then divide that over how many years you're in there, the compounded annual growth rate of the stock market might be 5 or 6, depending on whose article you want to talk to. So whereas in public equity, in private equity, you're getting a certain amount of return, but you're actually truly compounding it, because you're more unlikely to have those dips where you're taking big losses. So especially if you're diversified pretty well and you're doing a lot of good due diligence. So that's just like a little value bomb for the physicians out there on compound annual growth rate. And valuations are kind of different too, right? So how does it compare? Like, I know most businesses are valued on a multiple of the net, but there are other ways as well. So could you compare private equity to public equity valuations?
Yeah, absolutely. I mean, I think on the private side, the valuations are much more conservative, and there is what's called a liquidity premium that you pay in the public markets, just because you could sell it tomorrow if you want to. And there is that. There also can be quite a bit of arbitrage to be had between private and public because of that. But for me, as a lawyer by trade, I feel like the private markets are much more rational. They're much more logical. And I think a lot of doctors could resonate with that, where, if I look at a company, it's really easy to just look at a company's financials, easy to understand when you're going to get paid back, understand their growth, and make a logical investment. And with the public markets, a lot of times the valuations, look, as we've seen this year, for example, with, Wall Street Bets, Reddit, and GameStop, and these things, it's not often rational. Sometimes valuations can get a little bit extreme. And that's not to say that there isn't value to be had and you can't do well on that. But for me, particularly as someone who is a fiduciary to other investors, I have to make reasoned decisions and make sure that I have a lot of faith in the fundamentals. That's not to say that occasionally, I invest in venture capital, for example, that the valuations of earlier stage companies aren't very, very high, but obviously they're also growing incredibly fast. And for me, I'm comfortable with private investments when I can logically look at the company and look at the outlays and not have to worry about, hedge funds shorting it and things like that, and coming, and all those types of things that can make a public stock have a lot of volatility.
Right, right, and kind of be like almost drive some people neurotic a little bit. So
Yeah.
one thing you mentioned, I like the fact you mentioned the liquidity premium. So basically, because you can become liquid with a push of a button, you're going to pay a premium on that business's cash flow, because basically you're buying cash flow. And what I tell physicians, we actually talked about a little bit on day one, like if people self-directed their IRA is pretty much illiquid, but they are filling it up with businesses that they're paying a liquidity premium on, which doesn't always make the most amount of sense. So I always just say, hey, you might want to look at your retirement accounts. Why not get a self-directed account, maybe put some private equity into your retirement, because it's not liquid anyway, neither is your IRA. So that was something on day one we talked about. I think we talked about a little bit before this call as well.
Yeah,
So,
absolutely.
and so
Yeah,
some,
a self-direct. Oh, go ahead. I'm sorry.
I'll go, what were you saying about
I
self-directed?
was going to say a self-directed IRA is a great place to do private equity investments. I mean, I do my IRA is almost exclusively private equity for that reason, because it's long-term, high growth compounding capital that you're getting multiples. You want to make multiples and multiples on your money over time. So it's a great place. And also, obviously, you don't need to touch tomorrow unless you're 55 and older, for example, or 65 and older, realistically. So
Yeah. So, and also on day one, we talked about, we actually interviewed a portfolio manager for high net worth individual as well. So how would this fit into somebody's portfolio? Because I know most physicians kind of have, if they just have a financial advisor, they have a little cookie cutter portfolio, not really truly diversified. But based on what you see, what percentage should somebody's portfolio be in private equity?
yeah, absolutely. Honestly, it really is going to vary by that individual, how many assets they have, how much liquidity they need. And that's ultimately what my job is as an advisor to families in allocating. I think that if you look at a very, very, very wealthy family, several $100 million of assets, their portfolio can comfortably look like, say, Yale's endowment, which is, half or more in alternative private assets, real estate, private equity, et cetera. So they can be perfectly comfortable with that because they don't need that cash tomorrow. The other assets cash flow heavily. They keep plenty of cash available to manage liquidity. So you don't really need it. But then someone who has, $5 or $10 million, I think that you have to be much more conservative, and that could be anywhere from 10 to 20%, depending on how much it cash flows. But some private investments cash flow regularly, some don't. So it really just depends. I mean, you always want to be cognizant of liquidity because you can't regularly sell private equity. I mean, there are some instances you can do secondaries and things, but you have to be cognizant of that. So like I said, I'd say anywhere from, 10% to 50%. It really just depends. And even some people would be comfortable with more than that. It just varies by their risk threshold. And also obviously how much cash flow they need. If they spend virtually nothing and they just want to compound for future generations, they may be totally comfortable with more than that.
Right, right. And based on in your experience, what percentage of private equity have you seen in the average physician's portfolio?
I'd say 0 to 10.
Yeah, I think that's
very little. Yeah, very little.
And your dad was a doctor too, right? I think.
That's right. Yeah.
So, you got a good background for for what we're talking about on our audience here today.
Absolutely. My dad's a physician. My mother's a nurse. Both my dad, he was a faculty member at Baylor College of Medicine here in Houston. My sister was a faculty member at CEU in Denver. And I can tell you anecdotally, my sister, the first thing she did when she finished her residency and got that paycheck, and she called me and was like, what on earth do I do with this, 401k money, et cetera, had no idea what to do. And, I grew up with that too. I mean, my dad's not a business person. So I certainly can relate to some of the challenges here. And Dad is a very, very smart man, very sophisticated in a wide variety of areas, but, business just never was something he was particularly interested in. He has a financial advisor who I'm sure did an okay job, but I don't think he ever was willing to access the type of things that I do until I started doing them, of course. So
Right. That makes sense. So we're lucky to have you as a as somebody to ask questions.
yeah.
So now
Right.
when you look at a private equity deal, what are some of the things you look at to evaluate it? How do you know if one's good and one's bad? Like what are type of items you look at?
Yeah, no, that's a great question. And I would just say on that, one of the biggest mistakes people make is they want to diversify into private investments. And instead of doing it through, a sophisticated private equity manager or a group like mine, a multifamily office, or your private bank, for example, is they do what I call locker room deals. It's, here in Texas, it may be the oil and gas deal with your buddy, the real estate deal you heard about. And the reason why those can be dangerous, don't get me wrong, they can be great investments at times, and some are fine, but generally speaking, they may not have the adequate investor protections. Being that, for example, my firm's an SEC registered advisor, so we have plenty of restrictions. We are a fiduciary, for example, to investors. So, I mean, occasionally you have someone there doing a deal, it's not registered, you don't understand the fee structures, the legal docs are complicated, you don't know when you can get out. There are all kinds of pitfalls that I've seen many times. And typically when I say I've seen them, it's because one of our investors comes to me and says, hey, help me get out of this. Hey, what did I, how do I, what's going on here? They're not doing what they told me they were going to do, et cetera, et cetera. So a lot of times it's something like that. And so I'd say that what you have to look for, I mean, there are a couple things. Again, I mean, my background, I focus a lot more on the legal structures. What are the terms? Is the GP aligned with you? Is the manager putting in their own money in a deal? I think that's always important. I always make sure I put in a pretty large amount of capital for me and my family, and anything I'm willing to ask someone else to invest in with me. For example, also, I think it's important that you really read between the lines on fees. A lot of particularly private banks, I'm not trying to pick on them too much, but if you really read between the lines, and I'm talking like your big bulge bracket type banks, you have advisory fees that you pay, and you have administration fees that they charge, and then you have the fund fees. And I mean, you really end up paying a ton of fees, and your net returns end up not being what they should be because of that. So I think that's always something to be cognizant of. Be very fee sensitive. Make sure something's market. And then obviously, the liquidity structures. When can you get your capital out? Another one that's really important that people overlook, that rarely is actually just laid out and stated in documents, is how fast are they going to call the capital? Because one of the important things, I'll use private equity as an example. The typical private equity structure, and they're not all this way, but it's a 5-year investment period. So they have 5 years to make the investments, and then 5 years at the end to harvest them. And sometimes they harvest at the front half, but typically it's 5 and 5. That's a very normal structure. So it's a 10-year deal. They call that capital over 5 years, meaning you don't invest all of it up front. You may invest 10%, 15% 1 year, another 10%, 20%, et cetera. And so because of that, a lot of investors need to understand when they're going to have capital call. And that can be stressful, because if they think, I'm budgeting for 25% a year for 4 years, and they call 50% a year for 2 years, that can get them in a liquidity crunch. So it's really important not only to have a really good idea of what the capital outflows are going to be, but also, when you're going to get them back. And obviously you can't, this isn't a science, but at the end of the day, you really need to be asking these questions so you can make sure you manage your liquidity.
Right. So a lot of good points. Guys, hopefully you guys are taking notes on private equity. We're just really lucky to have David here giving us this insights. And this is really just a big overview. We could talk hours and go into some nitty gritty here, but for a good high level overview, we pretty much hit all the top points. And if you guys got any questions, just let us know. There'll be some links down below to contact us. And David, thanks a bunch for your time and explaining some insights on private equity today.
Absolutely. It's great to be with you.
Hey, busy healthcare professionals, it's Amir Baluch back with Wealth Strategies Summit. And we just finished a talk on private equity and why you need it in your portfolio. We're about to give you a super summary of what we just talked about with David Sawyer, who is CEO of Legacy Knight, which is a multifamily office. He's going to give us some highlights of what we just talked about when it comes to private equity in your portfolio.
Absolutely. Thank you, Amir. I appreciate the opportunity to participate. the reality is most high net worth investors, doctors especially, typically are underweighted to private equity as an asset class. And the reality is private equity over the last 25 years has outperformed the public markets, and most importantly, with a significantly lower amount of volatility. And as you know, I mean, if you're a physician, the last thing you want to be thinking about every day is whether your portfolio is going like this, like a roller coaster. And so having, diversified exposure to private equity within your portfolio, and it can be anywhere from, 10 to 30, 40% or more, just depending on your liquidity and your overall net worth, et cetera. That's really an ideal allocation to the asset class, whereas most traditional high net worth investors, particularly physicians, are probably less than 10% right now. And so what you get in private equity is you get less volatility, you get more diversification, you get lack of public market, just craziness you see on a regular basis, but also you get lower correlation in a lot of ways, depending on the strategies you're doing to what you're seeing in the public markets. And so for a lot of reasons, it just makes sense and adds a lot of value to a traditional portfolio, whether it's 10% or above 25. So I would highly recommend that investors look. But also, last thing I'd say, we talked about pitfalls, would be to make sure that you're doing it with the right partners who are sophisticated, who know how to look at structures, who are registered with the SEC, for example, who are regulated entities, who really have experience investing in this space, because private investments are illiquid, and so the worst thing you can do is get in a bad private deal that you stay in for a long time and can't get out. So I think it's really important to partner with the right people on it, but ultimately it's a highly attractive asset class that any high net worth investor, particularly physician, should be looking at.
Yeah, there you go, guys. You definitely got to tune into this one. Private equity in your portfolio, how to get in, and the ins and outs of it. This is one of the best ones that we got on in the alternative asset class segment of Wealth Strategy Summit. All right, thanks again, David, and we'll catch everybody.
Thanks very much.
Next one.
Hi, I'm David Sawyer. I'm COO and managing partner of Legacy Knight Multifamily Office, a Dallas-based investment firm founded in 2019. I specialize in alternative investments, both private equity, private credit, venture capital, growth equity, which is late stage venture capital. And I hope you'll tune in to discuss allocating private equity to a portfolio, why private equity can be such a great diversifier in a portfolio, why most high net worth individuals, particularly physicians, are underweight private equity, and how you can change that and the best ways to access it. So I hope you'll tune in, and thanks very much for joining.